If you're a retiree, a small business owner, or someone who keeps a meaningful amount of cash in a checking or savings account, there's a banking story you may have missed. A U.S. bank has failed, and the transcript we're working from presents it as the fifth U.S. bank failure of 2026. Now, before you hear the word failed and assume your bank is in danger, stop for a brief moment. One small bank failure does not automatically mean the American banking system is collapsing. In fact, the deposits at the institution discussed in this story were transferred to another bank, meaning insured depositors were protected. So why should anyone outside that Philadelphia community care? Because the interesting part isn't simply that one bank disappeared. It's what the failure can tell us about the pressures building underneath the financial system. Concentrated lending, higher interest rates, bond market stress, government borrowing, and the importance of understanding exactly how much of your own money is protected. And if you're approaching retirement, living primarily on Social Security and pension income, or running a business where cash balances can temporarily exceed $250,000, this matters even more because the question isn't, is America having a banking crisis? The better question is, what can we learn from the weakest banks before financial stress ever reaches the banks we use every day? Once you see the numbers clearly, you'll understand why this story matters more than the name of one small bank. The institution at the center of this story was Tioga Franklin Savings Bank, a small community savings bank with roughly $68 million in assets. The bank was taken into receivership, and the FDIC arranged for Second Federal Savings and Loan Association of Philadelphia to assume its deposits and substantially all of its assets. The branch reopened under the acquiring institution. For an ordinary depositor, that process can look almost invisible. You wake up, you open your banking app, your money is still there, your direct deposits continue, your checks continue to work, and the institution may simply have a different name. That is exactly what the FDIC system is designed to accomplish. But here's where the story gets more interesting. The transcript frames Tioga Franklin as the fifth U.S. bank failure of 2026 and compares that pace with only 2 failures in 2024 and 2 in 2025. Whether you're looking at an individual failure or a broader pattern, the important lesson is not to jump immediately to the conclusion that a nationwide banking collapse is coming. The lesson is to understand why small banks fail in the first place. Because banks don't all carry the same risks. A major diversified bank can have millions of customers, thousands of businesses, multiple lending categories, and enormous capital resources. A small community bank can be much more concentrated. It may depend heavily on one region, one type of borrower, one industry, or one particular segment of the local economy. That means a problem that looks small from the outside can become enormous inside that institution, and this is where the story connects to something that happened earlier in 2026. The first bank failure discussed in the transcript was Metropolitan Capital Bank and Trust, a Chicago lender. After its failure, analysts examined the bank's financial condition and found warning signs that had appeared well before the collapse. The transcript cites a KFI score from KBRA, which had placed the bank at an E rating in the third quarter of 2025. And here's the number that makes the story particularly interesting. The transcript cites KBRA data showing that 96% of U.S. banks that failed between 2010 and 2025 had previously received a KFI score of D or lower. Think about what that means. A bank failure can feel sudden to the public, but financial deterioration itself often isn't sudden. The warning signs can build quietly, loan losses can rise, deposits can fall, capital can become thinner, borrowers can become weaker, interest expenses can increase. And if those pressures continue long enough, a bank that looked perfectly ordinary to customers can become financially fragile. That's one of the most important lessons for anyone watching this video. The public usually sees the final event. Financial professionals often see the deterioration beforehand, And you don't need to become a banking analyst to understand the basic principle. When you hear about a bank failure, don't just ask what happened. Ask what kind of risk was concentrated inside that bank. With Metropolitan Capital, the concentration was particularly notable. The transcript says nearly 81% of the bank's lending was concentrated in commercial and industrial loans. Imagine your retirement portfolio. Now imagine putting almost all of it into one category of investment. If that category performs well, everything looks fine. But if that particular area of the economy comes under pressure, the damage can spread rapidly through your entire portfolio. A bank can face a similar problem, and Metropolitan Capital experienced significant losses in commercial lending. The transcript cites $13.9 million in commercial loan charge-offs during the third quarter of 2025, with its net charge-off ratio rising above 27%. Those aren't abstract numbers. A charge-off means the bank has effectively recognized that money it expected to receive from borrowers is no longer coming back in the expected way. And when enough loans go bad, the bank's capital position can deteriorate quickly. Now here's where we move from the individual bank to the bigger financial environment. Interest rates. This is one of the most important pieces of the story because higher rates don't affect only people getting mortgages. They affect banks, they affect borrowers, they affect bond investors, they affect the federal government, and they can affect the market value of securities sitting on bank balance sheets. When interest rates rise, existing bonds with lower interest payments generally become less attractive compared with newly issued bonds offering higher yields. That can push the market value of those older bonds lower. And if a financial institution owns a large portfolio of longer duration securities, a sharp rise in yields can create significant economic pressure. The transcript connects this dynamic to the broader Treasury market and notes that the 30-year Treasury yield had reached its highest level since 2007. This is where the story becomes relevant even if you don't bank with a small community institution. Because Treasury yields influence the cost of money throughout the economy, they affect mortgage rates, they affect corporate borrowing, they affect bond prices, they influence the returns available on safer investments, and they affect how expensive it becomes for the federal government to finance its debt. Now consider the scale of that debt. The transcript says U.S. national debt had crossed $39.7 trillion by July 2026 and had moved above 100% of GDP. The exact number will continue changing because government debt changes constantly. But the broader point is straightforward. When a government has an enormous amount of debt to finance, interest rates become increasingly important. Higher yields can mean higher borrowing costs over time, and that creates a feedback loop worth watching. Higher borrowing costs can put pressure on government finances. Higher government borrowing can increase the supply of Treasury securities that investors need to absorb, and the level of Treasury yields can influence financial conditions throughout the private economy. None of this means a banking crisis is guaranteed. That's an important distinction. It doesn't mean your local bank is about to fail. It doesn't mean you should withdraw your savings and put cash under your mattress. And it certainly doesn't mean every bank holding bonds is sitting on the same level of risk. The financial system is much more complicated than that. But this is where most people get caught. They think financial risk is something that happens suddenly. Often, it isn't. Risk can quietly accumulate for years. And the average customer may not notice because everything still works. Your debit card works. Your ATM works. Your paycheck arrives. Your mortgage payment goes through. Your bank app looks exactly the same. Then one day, the institution announces that regulators have stepped in. For insured depositors, the transition can be remarkably smooth. But there is one number every American should understand: $250,000. The standard FDIC insurance limit is $250,000 per depositor, per insured bank, per ownership category. The transcript emphasizes that insured depositors at Tioga Franklin were protected through the transfer of deposits to the acquiring institution, but this is where your own situation matters. If you're a retiree with $80,000 in a bank account, your situation is very different from a small business owner who temporarily has $400,000 sitting in one operating account because payroll and taxes are due. If you recently sold a house and temporarily have a large cash balance, that's different. Again, if you're managing money for a family member, your ownership category matters. The point isn't to become afraid of the $250,000 limit, the point is to understand it. Because the phrase FDIC insured should not be treated as a vague promise that every dollar you ever place in a bank is automatically protected under every circumstance. Know the institution, know the ownership category, know the balance, and understand how the coverage applies to your particular situation. That's not fear, that's financial literacy. Now let's talk about two different households. The reactive household hears about a bank failure and panics. They start moving money randomly, they make decisions based on social media posts. They assume the entire financial system is collapsing. They may even abandon sensible long-term investments because they're afraid of what might happen next. The strategic household does something completely different. They check their FDIC coverage, they review their cash balances, they understand where their money is held. They make sure emergency savings are accessible, they review the risk inside their retirement portfolio, and then they continue living their financial plan. That's the difference between reacting to headlines and responding to information. And the difference compounds. If you're 30 and building your first emergency fund, this story probably shouldn't change your investment strategy dramatically, but it should teach you something simple. Don't put all your financial eggs into one basket. If you're 50 and approaching retirement, the lesson becomes more important. You may have accumulated a much larger cash balance. You may have retirement accounts, brokerage accounts, and bank deposits spread across several institutions. Now is the time to understand how those pieces fit together. If you're 62 and preparing to claim Social Security, don't let a bank failure headline distract you from the bigger retirement questions. How much guaranteed income will you have? How much will you need each month? How much cash should you keep available? How much investment risk can you realistically tolerate? And how much of your retirement depends on selling investments during a bad market? If you're already retired, the most important number may not be your investment return, it may be your monthly margin. How much comes in, how much goes out, and how much remains after essential expenses. A financially resilient retiree isn't necessarily the person with the largest portfolio. It may be the person who has enough flexibility that one unexpected expense doesn't destroy the entire plan. And if you're a small business owner, this story deserves even more attention. Your operating account is not the same thing as a personal emergency fund. You may need substantial liquidity for payroll, inventory, taxes, or other obligations. That makes understanding deposit insurance and account structure particularly important. So what can you actually do this week? Start with your own numbers. Look at every bank account you have. Write down the institution, account, ownership, and approximate balance. Then determine whether any balance exceeds the standard FDIC insurance limit applicable to that account structure. Don't guess. Understand it. Next, look at your emergency savings. Ask yourself how many months of essential expenses that money represents. Then look at your retirement portfolio. Not just the return, look at concentration. If one asset, one company, or one sector dominates the portfolio, understand what happens. If that investment falls sharply, then review your debt. Higher interest rates can make expensive variable rate debt particularly painful. If you're carrying high interest balances, improving cash flow may be more valuable than chasing an additional percentage point of investment return. And finally, pay attention without becoming obsessed. One bank failure is a data point. A series of failures is something to monitor. But neither should automatically become a prediction of what happens next. That's the mistake people make when they consume financial news emotionally. They turn information into certainty. They hear about one failure and assume 10 more are coming. They hear about rising Treasury yields and assume the stock market must collapse. They hear about government debt and assume the banking system must break. Finance rarely works that neatly. The better approach is structural awareness. Watch the trend, understand the mechanism, know your exposure, and maintain enough flexibility that you don't have to make desperate decisions when conditions change. Because here's something history repeatedly teaches us. The most dangerous financial decisions are often made under pressure. When people feel they have no options, they sell at the worst possible time. They borrow at the worst possible rate. They move money without understanding the consequences. They make permanent decisions based on temporary fear. You don't want to be that household. You want to be the household that already knows the numbers. That's what this bank failure can teach us. Not that America is doomed. Not that every bank is unsafe. Not that you should panic. The lesson is much simpler. Financial systems are made up of thousands of institutions with different strengths and weaknesses. Some will fail, some will merge, some will grow, some will struggle, and the average American's job isn't to predict which institution fails next. Your job is to understand where your own money sits, what protects it, what risks you are taking, and how much financial flexibility you have. The transcript itself makes this point clearly. No analyst, regulator, or financial intelligence firm can know with certainty whether the pace of bank failures will accelerate or level off. What we can observe are the underlying numbers and the warning signs they reveal. That distinction is incredibly important. Prediction is difficult. Preparation is possible. And preparation is what protects households over the long term. So if you're watching this as a retiree, ask yourself one question tonight. If your bank were suddenly taken over tomorrow, would you know exactly how your deposits are protected? If you're a business owner, would you know what portion of your operating cash falls within applicable insurance coverage? And if you're an investor, do you know exactly where your biggest financial risks are? If the answer is no, that's okay. You don't need to solve everything today, but you should start learning. Because financial security isn't built by knowing every headline. It's built by understanding the few numbers that actually matter to you: your cash balance, your monthly expenses, your debt, your retirement income, your investment concentration, and your margin of safety. The fifth bank failure framing in this story may grab attention, but the deeper lesson is much more valuable. Banking stress doesn't usually arrive with a giant warning sign saying something is wrong. It can begin quietly: a concentration of risky loans, a decline in deposits, rising losses, higher interest rates, pressure on bond portfolios, and eventually, a small institution reaches the point where regulators have to step in. The average depositor may never see those warning signs. That's why financial awareness matters. Not because you should live in fear, but because you should know enough to make calm decisions. So here's the question I want you to answer in the comments. If your bank failed tomorrow, would you know exactly how much of your money is protected? And have you ever actually checked your FDIC coverage? And if this video helped you understand the banking system a little more clearly, subscribe. For more calm, data-driven coverage of U.S. finance, retirement, Social Security, interest, rates, inflation, banking, and the economic forces that can quietly affect your household. Because the goal isn't to predict every financial crisis. The goal is to make sure that when the financial environment changes, you're prepared. Before you have to react,